Good afternoon, everybody. My name is Lance Crawford, and this is my financial statement analysis. And the company I was assigned to was Kroger. A little bit about Kroger. Kroger is one of the largest supermarket chains in the United States, operating in the retail and grocery industry. Uh, Kroger was founded in 1883 and has since become the largest supermarket retailer in the United States, grossing annual sales of more than $132.5 billion. Services they provide include pharmacy, fuel center, and grocery shopping. Kroger operates over 2,800 stores across 35 states, and the Kroger headquarters is located in Cincinnati, Ohio. So the first set of ratios I'm going to get into is the liquidity ratios. Um, these measure a company's ability to repay its short-term obligations. These ratios include current ratio, quick ratio, and cash ratio. This measures the company's ability to pay off short-term debt without raising capital. Uh, Liquidity ratios determine how quickly a company can convert and use its assets, and a good range is typically between 1 and 2. Higher ratios typically mean it's less of a risk, but too high of a ratio could be a sign that the company is holding too much cash. So here are some of our formulas here. The current ratio we can find by dividing the current assets by the current liability. Can we determine if the company can pay off its current liabilities with its current assets? Our quick ratio we find by adding cash and accounts receivable and dividing that by current liabilities. So can it pay off the current liabilities with quick assets? And we have our cash ratio, which is cash divided by current liabilities. Can the company pay off its current liabilities with cash? So here we have a look at some of Kroger's liquidity ratios. The current ratio has increased, the quick ratio has increased, and the cash ratio has also increased. Generally, this is a sign that the company is able to meet its short-term obligations and is improving. And a cause for this increase could be the company has more liquid assets or they have increased their cash flow. So here we have Kroger's liquidity ratio versus the industry average. And Kroger is lower than the industry average in all three ratios. The current ratio is 0.745, while the industry average is a 1.21. The quick ratio is a 0.223, while the industry is a 0.58. And the cash ratio is a 0.115, while the industry average is a 0.37. And the next set of ratios we're going to get into are the efficiency ratios, which measure how efficiently the company can use its asset. This is a metric that measures how effectively the company uses its assets to generate income. A higher efficiency ratio generally indicates better resource utilization and operational efficiency. And this determines how quickly a company can turn assets into sales. So we have our asset turnover ratio, our inventory turnover ratio, days sales in inventory, and days sales outstanding. To find our asset turnover ratio, we're going to divide our sales by the total assets. So how much is generated from the assets for the company. And for inventory turnover ratio, we're going to divide the cost of goods and services divided by the inventory. How many times is inventory sold and replaced over time? Days sale in inventory is 365 divided by the turnover inventory ratio. So how many days is inventory held onto before it's sold? And days sales outstanding is accounts receivable divided by average daily sales. So how many days a company must wait to receive payment after a sale? Here's some of the efficiency ratios for Kroger. The asset turnover ratio has increased. The day sale and inventory decreases, and the day sales outstanding increases, along with day sales outstanding. So this generally is a sign that a company is using resources less efficiently. And here we have these ratios versus the industry average. Kroger is scored higher compared to the industry in 2 out of 4 of these ratios. Kroger scores higher in asset turnover ratio and day sales outstanding, while Kroger scores lower than the industry average in inventory turnover and day sales and inventory. So now we have our leverage ratios here, and the leverage ratio assesses a company's level of debt relevant to other financial findings. They also measure the amount of capital that comes from debt, so these ratios would include debt to assets ratio, debt to equity ratio, and interest coverage ratio. For our debt to assets ratio, we divide the total debt by the total asset. So we find out the percentage of assets financed from debt. And for debt to equity ratio, we divide total debt divided by shareholder equity. So how much debt per dollar of equity a company has. And for interest coverage ratio, we divide EBIT divided by interest. So how easily a company can pay its interest expense. Here are the leverage ratios. For Kroger, the debt to assets ratio has decreased. The debt to equity has also decreased, and the interest coverage ratio has increased. And here we have those leverage ratios compared to the industry averages. Kroger is lower than the industry average in debt to assets and interest coverage ratio, while they score higher than the industry average in debt to equity ratio. And now we have profitability ratios. Profitability ratios measure how successful a business is at generating profits relative to its revenue, operating cost, and shareholder equity. A higher ratio indicates greater profitability and use of resources. So these ratios include our gross margin ratio, our operating margin ratio, profit margin, return on assets, and return on equity. Our gross margin ratio is EBITDA divided by sales, so how much profit a company makes after paying cost of goods and services. Our operating margin ratio is EBIT divided by sales, which determines our operating efficiency. Profit margin is equal to net income divided by sales, the amount of pure profit from the revenue. Return on assets is net income divided by total assets, so how efficiently a company uses its assets to generate profit. And return on equity is our net income divided by shareholder equity. So here we have our profitability margins and ratios. The gross margin has increased. Kroger's operating margin has increased. Kroger's profit margin has increased. Kroger's assets, return on assets, and return on equity have all increased. And now we have those ratios against the industry average, and Kroger underperforms the industry average in all 4 of these categories. Now we have our market value ratios, which are used to evaluate investor sentiment. This is also to assess the company's stock price relative to its financial performance. So these would include our earnings per share, our price to earnings ratio, our market to book ratio, and dividend yield ratio. Earnings per share is found by dividing net income divided by total shares outstanding, so we can find out the amount of net income earned per share. Price to earnings ratio is found by dividing the share price by earnings per share to find how much investors are willing to pay per dollar of reported profit. Market to book ratio is share price divided by shareholder equity divided by total shares outstanding. And this helps us find out how a company is perceived by investors compared to its accounting value. And we have our dividend yield ratio, which is dividend per share divided by share price. So the amount of dividends attributed to shareholders. Here we have our market value ratio. Our return on equity has increased. Our market value ratio has increased. Our price to earnings has also increased, as well as market to book has increased. And here we have those versus the industry average, where Kroger scores higher in earnings per share, but scores lower than the industry average in price to earnings and market to book. These are the references that were used. They are the Kroger income sheet, the Kroger balance sheet, and the industry average benchmarks.